Live streaming is on.
All right. Good afternoon, everybody. This is Event Trader, and I am joined by, of course, Brandon Mars, options trader, as we go through the latest options playbook. So, without any further ado, Brandon, how are you doing this afternoon?
No, I'm doing excellent. How about you, Gavin?
I can't complain. Just kind of watching this market chop around like everybody else. Thought that we had a little bit of momentum going on, and then they pulled the rug out from underneath us here. Then obviously a little descendant triangle going on from that 10:50 time frame up until about 1 o'clock through the lunch hour. We have held up around 42, 44 in that area at the moment. Now coming back up and basically challenging the 50-day or the 200-day moving average on the S&P. We talked about this being a key level ahead of the MegaCap tech earnings later on. So it's definitely playing out to that. But I'd be really curious to hear what your current take is on the market.
Yeah, besides just trying to stay out of the way of the roller coaster when you're it's headed right for you. Yeah, just keeping an eye on this potential, what I would assume is a little bit of a squeeze here off of the lows. I mean, I would think that this would maybe have some legs to it. We had that bond auction this afternoon that came out. Yields dipped a little bit off of that. And I don't know if I was short and I had done pretty well over the last week or so, I wouldn't be super excited to remain short, going into the big tech earnings. And I would think that some people would maybe lock in some profits and maybe give some legs to this squeeze here. But, just I guess these days I say that, and I probably could have looked up from my screen, and the market could have completely shifted again. So just trying to stay nimble and ride a couple of these trends when you can catch them.
Right. Nah, Brandon's obviously referring to the 2-year note that they just sold 51 billion on. That's a lot of issuance to get out the door. So as Brandon said, positive reaction to it. That was probably one of the weird things, I guess. Maybe not weird, but I was a little surprised to see us tracking down while rates were also sliding lower too. You haven't seen them moving in correlation recently. So does that have your thinking? Does that change your thinking in terms of how you're watching rates, Brandon, when you're
Yeah,
factoring that into your trade?
I am watching rates a little closer these days, just as we had brushed up against that 5 mark on the yield on the 10-year. So definitely keeping a closer eye on that. And yeah, I was a little disappointed because, like you said, the rates were moving down, and I was like, well, the way that equities have worked lately, why aren't they going up? And obviously, there's a little bit more to it than that. I kind of, once I started to see that, I kind of started to put on my market maker conspiracy hat a little bit. And,
Yeah, me and Jim had ours going earlier because I know I had taken a long in the Nasdaq, and it looked like I was going to have a nice winner on my hand, and it just kind of reversed course pretty quickly there. So definitely a lot of conspiracies going on around that.
yeah, I mean, the reason I have it on is I'm almost thinking, are they trying to drive this maybe a little bit lower to pick up some shares on some of the tech names, before the earnings reports today? So, yeah, I guess we'll know soon enough. But that was kind of one of the thoughts I had when, especially when we had that dip around lunchtime. That just really kind of felt like a algo driven push down lower and lower. And, here we are. We've not quite recovered all of those losses, but a few more candlesticks here, and we might be having all those people from the lunch hour underwater that went short.
Yeah. So, do you have a leaning right now then in the broader market? Would you say in terms of a bias?
I'm starting to feel a little biased to the call side. Obviously with the grain of salt that we have had a pretty solid move down here over the last week or so. So again, not gonna bet the farm or anything on calls at one shot, but I'm starting to feel maybe a little bit bullish. I think at least maybe due for a little bit of a short term, maybe oversold bounce at least. But again, we got a lot of stuff going on after the market today, so you got to kind of take that cautiously.
Is there any sort of move or price action that you're watching closely that could kind of tilt you further in that direction, or kind of cause you to just crumple up the paper and throw it in the garbage can?
I already crumpled up about 6 pieces of paper this morning. So.
Well, is it like mega caps? Are you watching? I mean, obviously yields. Everyone's got their eyes on the yields, but that hasn't factored into today's price action so much. So, is there any one sector that you're kind of watching, or anything along those lines?
Yeah, I mean, watching all the big tech stuff as I always do. In particular, I'm not going to trade either of these. In particular, Microsoft because it has earnings, but just keeping an eye on that one and Apple just because they are such big drivers in the market. And Apple's been it's been a little weak recently, so if that could start creeping in towards the green, I think that would be a good sign. And then I do have some of the Dow names, like Goldman, the trade I have out there, and then like Caterpillar. It started to seem like today might be the day that the Dow maybe finally plays a little bit of catch up. And then I think you said it well earlier. It was Coke, and I think was it 3M?
Coke and 3M, yeah.
Yeah, so a little potential boost there as well. And the Dow's been pretty weak, so you got to kind of be cautious with that. But just kind of felt like it might be one of those days where it maybe starts to play a little bit of a catch up.
Okay. Real quick, if there's anybody listening to this, if you could just let us know if you're receiving this. I'm seeing somebody saying that Trader Audio is totally down. I have it going okay on my machine. So yeah, if anybody's out there listening to us, please definitely let us know if you could hear us okay. So we'll continue with this right now. And Brandon, what we're going to do is get into some of the current trades that you have going on. And one of them you took this morning, that would be Goldman Sachs. So you want to talk to us a little bit about this opportunity that you're seeing in GS?
Yeah, so Goldman was actually a trade from yesterday. So I actually carried that overnight, and just heading into the week, it had looked like it was just starting to get closer to that oversold area. It had dipped below that key 300 level, and I was kind of thinking that might be a potential bear trap. And unfortunately, the financials have just continued to lag really. And I also had to mix it up a little bit this week because most of my big tech firms were reporting. So I'm not trading any options on them during earnings week, as we've discussed before. So I was just kind of keeping an eye on that for a potential oversold bounce. And then yesterday, when we got kind of the dip down in the rates, thought it might be a little bit of a relief to the financials. And unfortunately, I was wrong. And started to see a little bit of strength today with the Dow moving up, but they just kind of continue to just kind of be under pressure, unfortunately.
So with Goldman, just taking a look that weekly that weekly average at 308 to 200 weekly, is that what are some of your targets for this name?
Yeah, so if it can get over the 303 level, which it struggled with both yesterday and today, then I would look for a move probably up to 305. That would probably be if unfortunately, if the option, wasn't underwater at that point, which it could be, that would probably be a area to exit. And then, 307, and then maybe that 20-day, but that might be a little bit of a stretch unless we really get some legs behind a potential rally.
Yeah. Any other bank names that are jumping out to you, or was it just kind of the Goldman pattern? Is there like Morgan Stanley? That could certainly fit into that oversold category, right? That thing's been on a steady decline since its earning, since the end of September. Trying to find a little bit of support at this 71 level. So, any other bank names, or the KRE, for instance, any of those kind of on your radar?
I actually don't look at the KRE all that much. Sometimes when you guys throw it out in the room, I try to take a glance at it, but it's not one that I've ever traded. So I'm a little naive on that one in particular, to be honest with you. Maybe JP Morgan. I mean, again, they're under pressure and it's kind of underperforming today, but you got 7 straight red candles on the daily chart there. Today is shaping up green, but we still have some time to go. But that just seems like it might be anytime after a stock goes down after earnings that were pretty solid for 7 straight days, it does make me a little bit nervous that the price action isn't lining up with the fundamentals. But it could also mean that it might be due for a quick short-term bounce.
All right. So Goldman, you had on, and NVIDIA, another name that you have playing, obviously. Curious, I was doing Cadence CDNS last night, taking a look through that, and it was a decent report, but certainly a slowdown there. Another AI chip maker, obviously not the bellwether that NVIDIA is, nor are they going to really have much of an impact on NVIDIA. But between them and SGH, just certainly seeing a little bit of weakness going on in that. So I'd be curious in terms of the stock chart for NVIDIA. Obviously, there's something there that you're seeing that supersedes concerns about any potential slowdown. So I'd be curious to see what had you excited about that chart.
Yeah, so coming into today, yesterday's candle was a fairly bullish candle. Didn't have a huge wick at the top or the bottom, engulfed to the last 3 days. So, it maybe showed some signs that, might be putting a little bit of a bottom from the recent pullback. And then kind of what caught my attention actually was just intraday. It was just kind of coiling and building. And at first, when the market was moving down earlier in the day before the lunch hour, it was holding up fairly well. So that was catching my attention. And then I'd actually mentioned in my notes this morning, AMD was right around that 100 level because that's been under some pressure too. And I started to see a potential bounce in AMD. And then, I kind of looked at the two of them together. And, I always like when you see a couple things in the sector moving for extra strength for the trade. And I just decided to pull the trigger. And also, it's a potential probably lotto play for me if it doesn't work out intraday, where I was probably going to take some sort of lotto type play into the earnings anyway, maybe on the QQQ or something like that. But, I think NVIDIA might be a pretty good choice, especially if, Microsoft or any of these guys come out later today and, kind of give a boost to the sector.
All right. I'll tell you what, I'd be curious. Let's go through the FANG names real quick. I just want to get your thoughts on charts going into these earnings, and I will start off with Microsoft here. I know you follow these names pretty closely, so I'd be curious to hear what you're what you're looking at right now. So Microsoft earnings this afternoon, of course. What's your thoughts on that stock going into this?
Yeah,
Not asking for a call, just general thoughts on what you see in the chart and what would intrigue you to possibly play it.
Yeah, so Microsoft, that chart looks pretty strong. I mean, if you were to look at the Microsoft chart, you really wouldn't even know that we just had this recent pullback that started on October 12th, right? I mean, it's dipped a little bit, but that has kind of held around that 330 area really well during the sell-off. So that one's definitely very intriguing to me. And I don't know. I would imagine that Microsoft would probably have a good earnings report. I'm not a fundamental guy, so I could be way off base on that one. But
Yeah, no, like I said, we're just talking purely charts, Brandon. So we'll put out that disclaimer that if they as the saying goes, defecate the mattress, and gets killed. We're not going to hold your feet to the fire there. But I do like this going in. I own it, my personal account, and I just purchased it a couple of weeks ago, based on the thought that there's definitely that idea that these mega cap names are finding safe haven buying during rocky times, and it's a phenomenon that we've now seen throughout this year. So I think that we could continue to see it. So I agree with you. I like the setup in this chart. I mean, we'll see what happens with earnings. Obviously that could be a big impact, but I haven't seen anything that really has me overly concerned that this is going to fall out of bed. What about Alphabet, Google here? And we'll talk GOOG. If you have a preference between that and the GOOGL, just let me know, Brandon. We can flip that over to that.
Yeah, I usually look at the GOOGL.
Done and done.
Mainly
Let's
because
pull that
I love Jim's like French pronunciation of Google. Anytime I do a trade.
And yeah, just so people know, the difference is, of course, the Google is the voting class shares, so that's the primary difference between the two. But yeah, another nice bounce off the 50-day moving average. So what's your thought on this chart going into it?
I mean, that chart looks pretty strong too, right? I mean, minus a couple days last week of a little bit of a pullback, you wouldn't necessarily know that the market's been down by looking at that chart. You got to imagine, unfortunately, with everything going on in the world and all the debacle of the GOP and everything else, there's probably a lot of people spending some time on Google these days. So. And I would imagine that companies, as we, enter, I don't know, a so-called recession. I don't know if I necessarily see that, but maybe a little bit of a slowdown that, companies might need to, get back out there and start advertising a little bit more. So, again, from a fundamental standpoint, you would think they'd be doing okay. And yeah, I mean, just them and Meta and Netflix, the whole XLC or communications sector has just been incredibly strong.
Yeah, and want to keep an eye out on Snap too. That's a name that looks pretty decent here to me. Got that $10 psych level coming into play here, Brandon. But if Google has some pretty good advertising revenues, then Snap is definitely a name for people to keep an eye out on here in case it's is able to rip higher. Let's see. Tomorrow, Meta platforms posting their results. Thoughts on Meta here in front of their earnings?
Yeah, I mean, a real strong chart. I mean, you've mentioned it too. I mean, the XLC has just been very impressive. So
it's probably the best chart that I've seen out there. I would say, certainly from an industry's perspective.
yeah, I would agree. And obviously, Meta got hit a little bit harder in this recent pullback than like Google or Microsoft, but kind of that big long consolidation for pretty much most of September. I mean, that remained very strong during most market pullbacks. So that's, I think, very intriguing of maybe a potential base. And you saw a little bit of a breakout. And I think this last week or so of maybe some profit taking, get some sellers out of the way. I would think with a nice report, this could make a nice move higher. But I guess we'll see how much Zuckerberg's spending on his virtual land deals these days. So I guess we'll see.
I believe he's pulled back on the Zuckerverse a little bit here. But yeah, no, that's a good point to point out. Those cost numbers are definitely something that people will be keeping a close eye out on. Thursday afternoon, we get Amazon, a little bit different from some of the others, is it's got that retail side of on the playbook too. Probably the weakest looking chart out of the group, as this has kind of been in a somewhat descending triangle since the middle of September, when it was trading at around 146. It slipped down to that 127 area. Thoughts on Amazon in front of its report?
Yeah, I mean, you're definitely right. I mean, hasn't hasn't moved above its 20-day, on this bounce here today. So kind of floating around that 125 area. I got a little bit of a downtrend form since mid-September. So, if anything came out on this particular report, that 125 level would probably be very vulnerable to, a potential little drop. And, you already had Tesla come out and hurt the consumer discretionary sector. So you got a little bit of pressure going on there. I mean, Tesla's making a little bit of a short-term bounce here, but definitely some pressure in the sector, and not exactly the strongest of charts headed into earnings.
All right, and then finally, Apple. AAPL, of course, they're going to be next week, mind you. They've decided to make themselves special. It seems like they always used to come out on the same day as Amazon, but I guess they don't want to share any of the glory. But much like Amazon, arguably one of the weaker charts out there. Now we got the 200-day moving average coming into play here. So a lot of negativity, it feels like, around Apple going into this report, right? We're hearing about how the iPhone 15s are kind of clunking along here, seeing low demand, seeing talks about cutting prices in China pretty aggressively. But it feels like every time people want to count Apple out, that's when they hit you with that report that you're like, oh, this is the best company on the world. So it has me a little skeptical. What's your thought on the Apple chart going into this?
Yeah, I'd have to agree with you. Every time you think Apple is down and out, they come out and they're just like, oh, we did $1 trillion in revenue last week.
By the way, we got $3 trillion in our bank account, right?
Yeah. So, no, there's definitely some issues. I was like reading about the Foxconn thing the other day. You got the Chinese authorities looking into Foxconn, and it's not something that you want to be dealing with in a country like China, that's for sure. I mean, again, not the best chart. Really below all the major moving averages, minus that 200-day that you mentioned, and kind of a downtrend, really, if you go back to the beginning of August of, making lower highs and, attacking that 170 level a couple times now. So, again, if there were any issues on that, with that 200-day sitting at the 170 level that it's tested several times, if it breaks below that, you would think that, you'd have to be careful of catching a fallen knife on that one. But, again, it's such a good company. I'm not going to go and bet the farm and, and destroy myself buying Apple puts by any means.
Yeah, no, it's definitely not been a way of making money for sure over the last 20 years or so.
Yeah, exactly.
All right, let's break into our topic then for today. And you have lined up for us a bear call spread, which obviously a lot of people looking for ways to play this downward market. So I think that this is going to be a pretty nice piece for people to pay attention to. So without any further ado, Brandon, you want to give us some of the basics on the bear call spread, and then I'll just kind of fire off some questions.
Yeah, so bear call spread, also referred to as a call credit spread. So it consists of one short call with a lower strike price and one long call with a higher strike price. Both of these calls are going to be in the same underlying stock, and they're going to have the same expiration. So you'd implement a strategy like this, really with the goal of profiting from a flat to a bearish move. So again, because this is you're collecting premium in this. Anytime.
Does your time frame matter for this, Brandon? Are you looking at weeklies as per usual?
And I probably should have started with that. I used to do spread trades a lot. I don't do them anymore. And the reason that I don't is, I'm generally trying to find the breakout moves. And one of the things that you find with a spread trade is they limit profits, but they also limit losses. So, one of the things that you're doing is you're spreading out your risk, and they help define your risk and your reward. So that's why traders use them. But if you're trying to play like a quick breakout, this strategy might not necessarily be appropriate. So on your time frame thing, I did read a few different articles as I was doing this research that a lot of people do them on a little bit longer of a time frame, 30 to 45 days. There's absolutely nothing wrong with doing them on a weekly basis, but I do think that some people tend to utilize them with a little bit of a longer time frame. But again,
would it be of the mindset that, hey, I think the stock's going to break down, I just don't know when? Is that kind of the mindset that you would have playing of something like this on a longer time frame?
Yes, exactly. So either that, or maybe it's some sort of protection on your overall portfolio where you're going to add this in as a hedge. But yes, I mean, if you thought that a stock was either just going to trade flat, or over the next 30 days, let's just use Apple. Let's say the earnings are bad, and you think that we're going to have a kind of a month of a downtrend. Yes, that's exactly when you would implement this strategy. Now would be a good example. If you were maybe starting to position how you thought that the market was going to move in towards the end of the year, you could maybe go a month out and do something that ends at the end of November or the end of December. But again, they're absolutely usable on a weekly basis, and I actually used to use them on a weekly basis. When I did utilize these trades. So this is a net credit strategy. So basically what that means is money is deposited into your account versus money being taken out of your account when you execute this type of trade. So the larger the spread between the strikes, the more premium that you collect, but also increases your risk. And the closer the strikes are to the price of the stock, the more premium that's collected, but the more likely that your strikes might end up in the money.
When you're looking at this brand, and then let's just say for Apple, for example, right? What's your plan for looking at the strike prices? How are you going after that? I know you said keeping it pretty close to the money.
Yeah, I mean, so again, it would also depend on what kind of move you think the stock is going to have. So if you really thought that the stock was going to take a dive, all right, we're going to crack the 170 level, let's call it, and I think this thing's just going to get smoked, and it's not even going to hold up at 150. I think we're going to the 130 range. Then you can get a little bit more aggressive with your strikes. If you think that Apple is just going to kind of be flat, or maybe just see a little bit of a dip, then you might want to keep it a little bit more conservative. So again, it kind of all comes down to what's your risk reward. Are you looking? I don't want to say hit a home run because it is a spread trade, but are you looking to take on a little bit more risk for your reward? For me in the past on something like Apple, I'd probably be looking at like the 170 and the 175 strike. So I'd skip over like the 172.5, and I'd have, a 5-point spread between my calls. That's generally speaking how I did it in the past. Maybe it's something like a NVDA with a little bit of a higher strike price. I might look at like the 430 and the 430, or excuse me, the 430 and the 440.
All right, no, that's perfect. So when do you start profiting from these?
So what will happen is you would execute the trade, and because it's net credit, you're going to immediately have the money in your account. So you really profit from these from essentially a combination. So if the stock price starts to go down, that will start to hurt the calls, which in this particular case you want, or just through time decay or theta, or a combination of the two. So in this case, theta or time decay is your friend. You know, for what I do with opening the puts and the calls, just, you know, as a straight play, theta is not your friend in that case. So if the stock goes down, you start to profit, or just through time as they decay, you will start to see an increase in your profits.
Okay. And does that then, I assume from that standpoint, does the length again of how far out you're going on these calls matter?
Yes, it would. So, you know, let's just say, I don't know, let's just say you're really, you know, bearish through the end of the year, and you want to go ahead and put this strategy on, and you want to do something and you think it's going to carry into the new year, and you know, you're going to do like a January expiration. So obviously, if you were to do an Apple, you know, spread strategy going all the way up to January, there's going to be more time value in those. So it's not going to swing quite as wildly with the changes in price. So your options will essentially decay less than something that expires this week. And then that's kind of the whole, you know, theory. And we could probably do a separate presentation on the Greeks, but you know, your theta or your decay is going to be much higher if you you know, picked a strike this week versus, you know, 3 months down the road.
All right. So obviously a hedging strategy. So what kind of potential profits are you looking at?
So yeah, again, kind of going back to my comment at the beginning, with spread trades, they do limit your profits. So your potential profit is limited to the net premium that you received. So in an ideal world, you would write the call spread, and essentially, you know, you would end up having the stock price move down below the lower strike, and that would basically make your calls both expire worthless, which is what you want, because again, you got a credit into your account for this strategy, and then you essentially, your profit is limited to whatever was put into your account, and your ideal goal is that you get to keep that money and that you don't have to use it to go back out into the market and to readjust this trade. So, you know, and again, you could go and you can make these very, very wide, and you can get funky with them, and you know, you can make some pretty interesting spread trades. I am not recommending to do that, but where I'm going with that is, you know, you can make a lot more money that way if you increase your risk. But this is more of the type of strategy that a lot of traders use, you know, where you're picking up a couple bucks, you know, here or there on your premium, and have that deposited into your account.
All right, and we're just keeping an eye too as markets push to afternoon highs here. As we're just into the 2 o'clock hour, just about 2 hours of trade left. Let's see. We talked about profit. How about max risk? Because this is kind of the important aspect in terms of where that limits your losses.
Yes. So I'll admit I'm gonna sound a little robotic here, because I am purely reading this off a piece of paper, because this gets confusing. So if anybody hears this and like, what in the world are you talking about? I had to study spread trades for a long time when I first started learning options. So, you know, it's not necessarily something that you would pick up in just hearing it once. So your max risk is equal to the difference between your strike prices minus the net credit received. So an example would be, if you were to, if you sold a 100 strike call at $2 and you bought a 105 strike call at $1, that would be a net credit of $1 that's deposited into your account. So your max risk is the difference in the strikes is 5 points. So, you know, 105 minus 100, and you have a credit of $1. So therefore you would minus 5 from 1, and your max risk is $4. And your max risk is realized if the stock price is at or above the strike price of the long call. So again, you're doing this because you have a little bit of a flat to a bearish tilt in your market outlook. So again, if it moved higher above your long call at expiration, that would obviously, the stock's going up, you made the wrong call. That's when your max risk comes into play. As I mentioned, this is a little confusing. What I would recommend doing if you were going to take a deeper dive into this particular strategy is to Google bear call spread profit and loss. There are a bunch of diagrams out there which will give you a sliding scale of what your max profit and losses are. And there are some calculators out there that you can kind of mess around with and put some potential scenarios in. And I will tell you, when I first started doing spread trades, there was a calculator on Fidelity that I used to always use. So I knew where my risk was. I knew what my return was. And, I basically knew exactly where I needed the stock to go or frankly not go. So I'd recommend playing around with those. I would, jumping back to something I said earlier about which strikes you pick. Some of those calculators, it can be really easy to be like, oh, well, if I just go into the NVDA, 600 call and I write the 200 and you end up with like this 400 point spread and you're like, wow, I can really knock it out of the park. Again, that is easier said than done and will come with maybe more risk than you want to be taking on.
Makes sense. So I know you've addressed this, but in general, just kind of wrapping up the entire strategy. You talk about this involves collecting a premium. So from that standpoint, what would be an ideal time to use this strategy, not just in terms of expectations for market direction, but in terms of pricing on the premiums?
So since it involves the collecting of the premium, the basic theory behind options would be that traders would utilize this strategy when premiums are higher. Because again, you want to, in theory, there's a lot more that goes into this, but you want to be basically a premium writer or collector when premiums are high. And that would give you the thought process that eventually those premiums would come down to normalized levels, which would decay the premium, which again, you want in this case, because you want that option to end up worthless. So, if you had a situation where, I don't know, we're in earnings season and we're talking about Apple. So if you wanted to go into the Apple earnings, that's when your premiums are going to be high. So if you wrote a strategy like this, you're going to get that premium or implied volatility crush after the earnings, where the premiums on these options come down because the news is out of the way. So in that particular case, what you ideally hope for is you get a combination of, you picked the direction of the stock price correctly, so it starts to go down, so that works into your favor. The premiums start to return to normalized level, basically, chipping away at that premium. And then you also get the potential combination of time wearing down your premiums. So that would be in an ideal world. I would say that there are some traders that if they want to play earnings, again, I'm maybe not the best person to talk to about this because I don't do it, but again, a spread trade spreads around your risk. So if you wanted to take the risk of potentially playing some of these earnings, this is a way to do it with options where you have a little bit more of a cushion from a risk return perspective.
Okay. Now, I guess the one thing about this is that it might be difficult to get approval for this, right?
I think it's usually easy to get approval, but you do usually need to have additional approval levels. And again, I should maybe take a step back. All my approvals were done so long ago that I've mentioned this on a couple calls before. I know the brokerage houses have changed some of their rules. So actually, Gavin, you might be spot on with that now that I think about it. A lot of them have changed some of their rules and approvals because of the explosion in options. So you should be able to do it. I mean, again, as long as you have, adequate cash usually to cover any sort of trades, in case they do get exercised accidentally, you can usually get that approval. So, but if you do want to do this and you tried to implement one, you'd probably get blocked by your broker out of the gate unless you talk to them.
Out of curiosity, how are you finding brokers with options trading? Do you find that they're getting a little bit more stringent, or with the explosion of it, do you think that they're kind of just, don't want to say a money grab, but much more willing to kind of lax the rules in order to keep the momentum going?
Well, I'll tell you that I will never trade an option at Fidelity again because of the
Really?
rules. Yeah. So I think one of their new rules is I think you have to have $1 million in your account to trade an option on a Friday. I might be off
On a
on the,
Friday?
yeah, because of the
Just
zero DTE.
really?
Yeah.
Wow.
So there's that, and they became a lot more trigger happy with closing out my options positions on a Friday as we got closer to expiration. And look, I understand for them as a risk perspective, like, if you go and buy a bunch of cheap, options for a penny on a Friday looking to hit a home run, and all of a sudden those somehow end up in the money, and you bought like 100, calls on Apple, and you got a sign, that's a massive chunk of money that, a retail trader might not have sitting there in cash. So I understand why they did it from a risk perspective, but for me, I always closed out all of my options very diligently. And the thing that I did not like that they did was their risk management team had no rhyme or reason. Some days they closed out some of my deals at 3:10 in the afternoon. Sometimes it was at 3:59.
It was
Sometimes,
like whenever somebody wanted to wrap up their day, basically.
yeah, it was like, oh, my coffee's done. I'm gonna hit the road early for the weekend, and I'm just gonna go close out all these options. And there was one time where I was like 50 cents out of the money, and they went and closed an option on me at like 3:15. And I'm like, well, that completely takes away your potential play on, a short squeeze. Like I strategically made this play and you're taking it away from me. So there was just no rhyme or reason. I'm sure if you called them, they'd give you a very boilerplate specific answer, but it's just not true. So yeah, they've become a little bit more stringent in that regard, and rightfully so, because I think they had just millions and millions of dollars of options exercised on Saturday morning.
Yeah, I'm sure. All right, so just continue to keep an eye out that 200-day moving average. Continue to flirt with it. So we got about 2 hours left in the training session. So, Brandon, any parting shots before we let you get going here on the bear call spread or the markets in general?
Yeah, the last thing I would add is, you are going into this trade specifically to, limit your risk. But that doesn't mean that it's not out there come Friday when you have two different, option legs that are now, you're either short or long in your account. So, basically good segue from what we were just talking about with the brokers. You just make sure that you keep in mind that you have two different options out there in this particular case. So it just takes a little extra due diligence on monitoring to make sure that all of your positions have been closed properly.
All right, so there you have it. So we are going to be posting a replay of this, of course. So if anybody missed anything or had any follow-up questions, definitely let Brandon know. We'll be happy to pass it along, and you'll be able to hear this replay as well. So, hey, Brandon, as per usual, always a fun time talking with you here, and always a pleasure to hear what you have to say on these topics. As you're always bringing forward some interesting new topics for people and different new strategies for people to try out. So very much appreciated, sir.
Thank you, Gavin.
All right, we're going to shut down audio then temporarily. We'll be back up in a couple of minutes, and we will be ready to discuss the final hour and a half of trade and take a look forward at Microsoft and Google before they hit the after hours. So we'll be back on shortly.